If you're hearing things like, Bitcoin has reached the end of its cycle, the 4-year cycle is about to repeat, it's time to take profits, or everything will crash. Backhand index pointing right, I want you to pause for a moment. Because after more than a decade working in the US financial industry, I've realized something critical. Most investors don't lose because they don't understand cycles. They lose because they believe in cycles too mechanically. They believe that every 4 years, Bitcoin must peak and then collapse. They believe history will repeat itself exactly the same way. But in US financial markets, no cycle exists in isolation from the macro environment. A cycle is only a reference framework, not a pre-programmed destiny. Yes, historical data shows a very clear pattern. In the previous 2 cycles, Bitcoin reached its peak roughly 35 months after the bear market bottom. After that, the market entered a brutal correction, falling more than 75%. Today, Bitcoin is up about 800% from its 2022 bottom and is moving into a time window that, in the past, marked the end of bull markets. No entry, but history does not automatically repeat itself. It only rhymes. We also need to properly understand halving, the core mechanism behind Bitcoin cycles. Halving cuts the issuance of new Bitcoin in half, but its impact is not immediate. It spreads gradually through the system. New supply decreases, selling pressure from miners weakens, and the market only reacts strongly months later. In previous cycles, it took nearly 18 months after halving for the bull market to truly explode. The issue is that Bitcoin is currently standing at a very sensitive intersection point. Measured from the bear market bottom, we're approaching historical peak timing. Measured from the April 2024 halving, we're also entering a higher risk zone. And if you look only at time-based metrics, the concern is completely justified. Backhand index pointing right, but US financial markets never look at time alone. We must look at monetary policy, capital flows, market structure, and the behavior of large institutions. And it's precisely here that the current cycle begins to show differences that previous cycles never had. The real question is no longer, is Bitcoin nearing the end of its cycle? But rather, are we applying an old model to a market that has fundamentally changed? And that is exactly what we will analyze in this video. Once we understand that the 4-year cycle is not an exact countdown clock, the next crucial step is to look directly at the data, but data in the right context, not numbers detached from reality. Let's start with history. In the 2 most recent cycles, Bitcoin peaked roughly 35 months after the bear market bottom. What followed was a severe downturn, with price drawdowns exceeding 75%. This is why many investors today believe we are walking the exact same path again. But here's the problem. History gives us patterns, not carbon copies. What happened in the past is only relevant if the underlying conditions remain the same. And that is precisely what many people are overlooking. Next comes halving, the most misunderstood factor of all. Halving is not a peak-forming event. On the contrary, it is a catalyst for expansion. When miner rewards are cut in half, the amount of new Bitcoin entering the market drops sharply. But this impact does not happen overnight. It takes time to propagate through the system, from miners to exchanges and eventually to long-term investors. In both previous cycles, it took nearly 18 months after halving for the market to enter its strongest growth phase. And only after the market became overheated and euphoric did the downturn phase begin. This brings us to a critical reality. Bitcoin is currently positioned between 2 different ways of measuring time. If you measure from the bear market bottom, then yes, we are approaching a historical peak zone. But if you measure from the April 2024 halving, the market is still in the early stages of its expansion phase. This is exactly where many investors become confused by conflicting signals. And when the market sends mixed signals like this, the deciding factor is no longer how many months have passed, but whether the macro environment supports or suppresses risk. In previous cycles, Bitcoin peaked while the US Federal Reserve was tightening monetary policy. Interest rates were rising, liquidity was being drained, and the cost of capital was becoming expensive. In that environment, risk assets like Bitcoin had little room to survive. Today, however, we are witnessing a completely different scenario. The Fed has begun cutting interest rates. Borrowing costs are falling. Liquidity is returning to the market. And throughout US financial history, it is extremely rare for a major bull market to end while monetary policy is easing. And that's not all. Bitcoin's capital flow structure has fundamentally changed. For the first time in history, demand from large institutions exceeds the supply of newly created Bitcoin by a wide margin. This is not short-term speculative capital from retail investors. This is capital coming from ETFs, pension funds, and financial institutions with multi-year, even multi-decade, investment horizons. When demand outweighs supply by multiples, the market no longer operates under the old logic. What's particularly notable is that despite the strong price appreciation, Bitcoin has not entered a bubble-like state as it did at previous peaks. On-chain valuation metrics show that price is not significantly detached from underlying value. This tells us one thing very clearly. The current market is not being driven by extreme emotion. Finally, we must acknowledge an important truth. Bitcoin has matured. A more mature asset tends to react more slowly, exhibit longer cycles, and show less chaotic volatility. In U.S. financial markets, when an asset class enters a mature phase, cycles typically extend, they do not compress. And that is why, if you focus only on the 4-year cycle and ignore all of these factors, you may be positioning yourself to exit the market far too early. But it is precisely at this moment that the market begins to ask the most dangerous question for investors. What if the cycle doesn't end on schedule? After more than 20 years of observing U.S. financial markets, I've seen a very clear psychological pattern repeat itself. Investors don't fear losses the most at the bottom. What they fear most is losing profits they already have. And when that fear combines with a rigid belief in cycles, it often leads to the same mistake: selling too early. The Bitcoin 4-year cycle, by nature, was formed during a time when Bitcoin was still very small. Back then, capital flows were dominated by retail investors. Prices reacted quickly, emotion spread rapidly, and the market could swing from euphoria to panic in a very short period of time. But today's Bitcoin is no longer the Bitcoin of 10 years ago. The current market now has ETFs trading on U.S. exchanges. It has capital flows from institutions managing trillions of dollars. It has investors who don't buy Bitcoin to trade short-term, but to hold it for years as a strategic asset. When the structure of market participants changes, price behavior is forced to change as well. This helps explain why, despite Bitcoin's strong rise in the current cycle, we have not seen the familiar signs of a cycle top. There is no explosive, irrational FOMO. There is no massive wave of retail money rushing in with extreme leverage. There is no severe detachment between price and underlying value. Instead, we are seeing a market that is rising in a disciplined manner. And this is exactly what makes many investors uncomfortable. Because they are used to emotionally charged cycle tops from the past. When emotion doesn't show up, they begin to doubt, am I missing some kind of danger signal? In U.S. finance, this is known as the fear of patience. When investors cannot tolerate a market that rises slowly, steadily, and under control. Another factor that is often underestimated is the role of miners in the current cycle. After halving, selling pressure from miners has dropped significantly. Many large US-based miners today no longer sell Bitcoin immediately after mining it. They have access to hedging tools, traditional capital markets, and cash flow management similar to real businesses. This weakens one of the selling forces that contributed to cycle tops in previous eras. When we put all of these pieces together, easing monetary policy, institutional demand overwhelming new supply, a market that has not entered extreme euphoria, and a fundamentally changed participant structure, a clearer conclusion begins to emerge. Backhand index pointing right: the biggest risk right now is not that Bitcoin is about to crash, but that investors are misreading the environment. That does not mean the market will move straight up. It also does not mean there won't be sharp corrections. But it does mean that mechanically applying old time-based models to predict the top can lead to inaccurate decisions. And in finance, making the wrong decision at the right time often causes more damage than making the wrong decision at a bad time. That's why, instead of asking, where is the cycle top? The question a professional investor in the US always asks is, how is the current data changing, and where does the real risk actually lie? Because markets do not reward those who guess the top. Markets reward those who read the context correctly. After everything we've just analyzed, there is one thing I want you to take with you as you leave this video. The most important question is not, is Bitcoin about to form a top? But rather, are you making decisions based on current data, or on fear shaped by past cycles? The 4-year Bitcoin cycle is a useful tool. It helps us understand market structure, the rhythm of supply and demand, and identify periods of elevated risk. But when a tool is treated as an absolute prophecy, it becomes one of the most dangerous traps for investors. History gives us patterns. Context determines outcomes. And the context of the current cycle is fundamentally different. Monetary policy is easing rather than tightening. Institutional capital is overwhelming new supply. The market has not entered extreme euphoria. And Bitcoin is more mature than at any point in its past. That does not mean risk has disappeared. It also does not mean the market will not correct. But it does mean that acting purely out of cycle-driven fear may cause you to miss the most important part of the trend. In U.S. finance, the investors who survive the longest are not those who guess the top correctly, but those who manage risk well, maintain discipline, and are willing to adapt as data changes. They don't try to defeat the market. They learn how to move with it. And if there is one final message I want to leave you with, it is this. Backhand index pointing right, don't ask what the market will do next. Ask yourself how you will respond when the market changes. Because the real edge in investing does not lie in prediction, but in having the right mindset when uncertainty appears. If this video gave you a different perspective on Bitcoin, please hit like to support the channel. If you want to continue receiving deep, slow, data-driven analysis instead of emotion-based narratives, subscribe so you don't miss future videos. And leave a comment below. Are you looking at Bitcoin through data or through fear? Let's discuss.